do yourself a favour, get a ruler and take it into the exam. You've seen those questions, haven't you, in the question pack? You've seen how many figures there are. And you've got the blurb on one side, share capital, stock at a certain date, and you've got the figure on another side. Again, under exam conditions, it can do funny things to our brains. So do yourself a favour and line up the ruler and work your way down the page. Now, the other important thing you always do when you get a question like that are two things. Whenever you get an exam question, what should always be the first thing that you do with an exam question?
Read it.
You read the question. Now, that's not superficial, that's very important, because sometimes you can get a very large case study. Yes? Have you had that before?
Mm-hmm.
Yeah? You get large case. But there's no point reading the case study first unless you look at what you're actually required to do, because that will direct your gaze, direct your reading, direct your thinking. And it's the same with this list of figures. You need to start by looking at what's asked of you. Is it a profit and loss account by itself? Is it a balance sheet? Is it both? What are the dates concerned? You've got the template, you get the template in the exam. Write in the dates, because we've got two types of accounts. We've got one that is over a period of time. Which one is that? Is it the P&L or the balance sheet? Over a period of time, historical. P&L. Which one is the snapshot?
Balance sheet.
The balance sheet. Okay, so put the dates in. If it's the profit and loss, it's likely to be for the year 2. If it's the balance sheet, it will be figures as at that one date. There is a big difference between those two. Once you've done that, with that list of figures, you start at the very top with your ruler, you line up and you tick it off, and you put the figure in the template.
Yes.
And you work your way down and you tick each one that you pick up. You have to hand in all of your paperwork, including your question paper. Every year, the majority of you will not be able to balance your accounts. And one of the reasons is because you haven't lined up the figures. You've got, for example, stock as at something date, and you've picked up, for example, the figure relating to motor vehicles. You haven't lined it up, and the other thing you haven't done is you haven't ticked it, and you run out of time. So if you go down that list, line it up and tick it off, and every time you do, you use that figure, either the profit and loss and or the balance sheet, because we're going to have a look at a couple of things where figures go into both statements. Be careful, because what I might do with that list is I might put in figures that you don't use at all. The reason for that might be to test whether you appreciate the difference between the dates on the particular statements. So it might be a date that is outside the period that you're looking at. And this is very important in the workplace. I was speaking to a colleague of mine on Saturday. She works for one of the biggest insurance companies in the world, and she is a software project manager. And she said one of the biggest problems that they have is people not understanding how to put the figures together for a business case. Every single adjustment that's made, particularly on the large side, has got to have a business case, because the resources, the programming time, the personnel, subcontractors, whatever it is, need to be allocated, and you need to know what to include and, more importantly, what not to include. Guys, over there, that window's open. Are you going to draft there? No, you okay? If it gets a bit, then I'll shut it. Come in. Did you have a problem with the bus? No? Okay. So if I think of any other points as we go through, I'll Any questions on the question pack? The other thing, and I did see a student, I put up, because somebody asked me yesterday, I put up in Word document form the templates, okay? I did see a student yesterday constructing an Excel spreadsheet. Guys, again, trust me, that ain't no good for you because you need the practice of actually picking up those figures and knowing where to put them, because in the exam, you're not going to be able to take a computer in. You're going to have to write it by hand. And if you just practice those questions until they get embedded in your brain, you won't even have to think about it. The other thing that I'm going to include for the first time this year, because I did take it out before because it was only on a minor level, I am going to include depreciation. And I'm going to look at two particular methods for depreciation because I think that's important.
Reducing balance and straight line.
And I'm doing this, I've done a study note for you, which I will put up, and we will cover that in a very brief sort of mini lecture, you know, as we do go through. But that is going to be in the exam. So in the study notes, I've also done you a mini question pack and a mini answer pack, and you're having both together. Again, for the first time this year, I put up on Study Space, also known as Blackboard, the Learning Management System, a worked example, question 6 from the study pack, with the answer. And unfortunately, a lot of you didn't listen to me, and I can understand why. It must be a little bit frightening, a little bit disconcerting to be faced with that amount of information. The templates alone look a bit nullifying. But you need to work through the questions. You need to practice them. That question 6 worked example with the answer is a sort of backup in case you have a question about it, so that you can see where the figures go. But the intention, the reason I put it up, is not for you to dive straight in and just look at that. You need to have a look at the study notes on financial statements. They're labelled financial statements. They were available from last week, and thanks again to that student who pointed out the fact that you couldn't actually see them because the default on the software is do not show. It used to be automatically that it was shown, and you'd have to select the other option. Okay, let's continue. How perky are you feeling? A little bit uncomfortable.
No.
Quick quiz. Sources of finance. We covered that last week and the week before. Sources of finance. Are you ready? Again, do yourself a favour and practice. Practice writing it out. I'm module leader of 2 of the maths modules, a first-year maths actuarial maths and a second-year actuarial maths. And the students are given a big handbook, rather like study notes, yeah? And at the end of every chapter, exactly as you've got, there are questions. And the idea is that students come to the workshops and practice the questions. Very few students turned up to the workshops. The failure rate was catastrophic because they hadn't practiced the questions. They read the question, they read the answer, and they thought, easy peasy. Again, under exam conditions, it's quite different. If you can, get into a study group of no more than 4 students, and as you come nearer the exam, find a room that you can work in together quietly, but also what I used to do with my friends is make up exam questions and practice on each other. Practice. If you can actually write a good exam question, you have to know the subject.
It's not a good idea.
So you're halfway there. And the other thing that we did is we gave sort of mini lectures on different subjects that we knew. Because each one of you in a study group is going to have different skills, things that you're comfortable with and other things that you're not comfortable with. Right, let's see how comfortable you are with sources of capital, shall we? Let's begin. Write it down. 2 types of shares. two types of shares. Three types of other capital. Shares are capital. It's something that you're putting into a business, you're contributing. Three other types of capital. Now that cotton on is over, you should be able to do this with ease. If you want ownership in a limited company, what should you own and what does it enable you to do? Tricky question. If you want ownership in a limited company, what should you own? Tricky and yet simple. And what does it enable you to do? You want ownership. Bless you. Bonus mark. What type of share enables you to carry forward if you haven't been paid for that particular year, so you haven't received your dividends? If the business cannot afford to pay you in that year, there's a particular type of share, and you would carry it forward and get paid in the next year, together with next year's so-called dividend. And it's a funny type of thing, because it's not really a type of share, is it? It's more like a kind of loan. As a shareholder of ordinary shares, you're guaranteed a dividend every year, aren't you? Yes or no? Write it down. The shareholder of ordinary shares, are you guaranteed every year to get a dividend? Guaranteed every year? Let's see how you've done. Two types of shares. Preference, good. And ordinary, good. Three types of other capital. Shares of capital, goes into the business. Yes. Bank loan, good. Venture, very good. Any others? Bank loan, venture capital. Any others? Private loan, yes. Good, yeah. Any others, Stephen, you can think of? Okay.
Overdraft.
Oh, okay, thanks. Loan from the bank? You really should come in the back, but come very quickly because we're just finishing off the quiz. Loan from the bank? Read the small print before you sign. Loans from other sources, well done. Venture capital funds, yes. Good. Right. Say again?
I don't know if other sources sort of covers it. You could have loans from other businesses.
Yes, you could. Loans from other businesses. Yes. If you want ownership in a limited company, what should you own and what does it enable you to do?
Majority.
So you should own a what? Share and have the majority. Especially ordinary. Ordinary shares get the vote. Right. What type of share enables you to carry forward unpaid dividends? Notice it's in a little quote. If the business cannot pay in 1 year.
Dividends.
No.
Dividends.
Type. Not Not good enough answer.
Dividend.
Specific. What are you doing? You're carrying it forward from one year to the next if you can't pay. And you're going to not only pay it in the next year, but you're going to get next year's dividend as well. Therefore, it's doing what? It's mounting up. What's another word for mounting up? Yes, so what type of preference share is it? Cumulative. Cumulative. That was a tricky one. That was just to see if your brains were working, okay? It's cumulative preference shares. As a shareholder of ordinary shares, are you guaranteed a dividend every year? Ordinary shares guaranteed a dividend? Hands up who says yes. That was a strategic withdrawal. Okay, hands up who says yes. Yeah. Hands up who says no. There are just a couple of fence sitters. That's good. No, this is one of the differences between a preference share, and it's kind of a misnomer to call it a preference share because you are guaranteed a so-called dividend. You get a share of any profits. But a shareholder with ordinary shares has to wait until a dividend is declared for them to get anything. They get the remainder, and only if the directors announce a dividend will be paid. So some years they might not be paid. Bearing that in mind, this is a very tough question. Let's see what you think of this. X Limited has not paid a dividend for many years and instead has been reinvesting profits in the company. Sounds good. It now has significant cash balances and finds that there are no suitable investment projects in which to invest. The directors are therefore considering paying a substantial dividend. Okay? They've been saving up, they've been investing in the business, reinvesting in the business. They've now got very large cash balances. Explain why the directors are reluctant to simply retain those funds, the cash balances, and wait for some suitable project. That's a very hard one. There are 4 reasons. Write them down if you think you know them. That's very hard. It might help if you actually look at certain companies yourself, certain PLCs, you have a look at their balance sheet and you have a look at the figures, for example, in current assets, cash balances. If they're very large, you might want to ask yourself these questions. This is hard. Anybody got any ideas on this? Yes?
Taxes.
Taxes is an interesting one. The interesting thing about when you pay dividends, it's not the company that's going to pay the tax. You're going to be taxed as an individual, and you're going to be taxed as unearned income. So, good try, but in this case, actually, no, it's not necessarily tax. No. You've got a company. Yes, Stephen.
You have less money. You have less money for when people do arise to invest in.
That would be the case for keeping the money in. No, that's okay. No, that's the other side of the coin. Yes. No, what I'm talking about is why they want to disperse the very vast cash funds. You've got a business. Yes.
Is that because if they don't pay out, they're going to get a bad reputation, sort of, that, well, why should I buy shares if you're not going to give me the money back?
Very good, yes. Why should you, think about it, why should you buy shares in a business? It's your investment, isn't it? It's your project investment, if you like to look at it that way. Why should you buy shares in a company if you're not going to get a return on that investment, if you're not going to get dividends? They're not going to pay you any income. That's a very good reason, isn't it? In this day and age, with everything that's happening globally, what might be another reason? And again, for the entrepreneurs amongst you, this is one to spot. Say again? What does it do to an organ? What does it do to a company?
Make them worth less.
Makes them what?
Worth less.
It makes them worth less. Yes, it does. It actually does. Yes. Shareholders, possible answers. Notice that I've said possible answers because there could be permutations on this. Shareholders do not like money. If you've invested, you're a shareholder. They don't like the money to be sitting there. They want some kind of income. And if they're not going to get it in dividends, they want the company to be investing in projects that are going to earn them even more income. So that's one situation. Excess cash lying idle might suggest weakness. How about this? Weakness and incompetence in the company and in the directors. Potential investors might be reluctant to invest in that company, again, because their returns will be limited to low risk-taking. That's a very difficult area, because if we already discussed in a previous lecture the situation with Marconi, where they had massive cash reserves, they made the mistake of buying technology licenses, and as we know with technology, it moves on very quickly, and they were left with a very worthless asset. Investors expect a return on their investment, and a high level of cash may make the company unattractive to investors, and therefore the share price, the perceived worth of the company, is less. And a significant amount of cash, this always interests me, might make the company attractive to a corporate acquirer, a buyer, who can take over the company and use the retained funds to invest in projects elsewhere. Could even lead to the directors losing their jobs, the usual fallout because of weak management. And many years ago, before we had particular rules and regulations regarding to pension funds, it could make an organisation vulnerable to have that amount invested as pension. Okay, that was a tough one. That was a tough one. Let's continue from last week's lecture. We were on slide 56.
Ah.
56. Liabilities. If assets are divided between, or rather subdivided between fixed assets and current assets, fixed assets being the assets that you would use every day continuously in the organisation to keep it going. So, for example, a building, if you're a software designer, developer, specific computer equipment, furniture and fittings, motor vehicles. Current assets are deemed to be working capital. It moves very quickly. Balance at bank is going to be up and down like a yo-yo. You're going to be having cash in, hopefully, from debtors. What does debtors mean? What does the word debtors mean?
People who owe you money.
Good. People who owe you money. You've made a sale. They haven't paid cash at that particular time, perhaps because they're a particularly good customer of yours, so you allow them 30, 60 or even 90 days credit. And you're waiting for that cash to come in from them, the debtors. So current assets are going to move all the time. Sorry, I should have this up, shouldn't I? Okay. Liabilities are equally subdivided between fixed liabilities, long-term liabilities and current liabilities. If it's over 5 years, it's long-term. So in the exam, read it very carefully. If you, for example, got a mortgage and the mortgage is repayable within 3 years, is it fixed or current liability?
Current.
Current liability, good. Don't make that mistake. Yep. Current liabilities, this is part of working capital. A big current liability is always going to be creditors. Creditors are the people to whom you owe money. So, for example, where is it? Oh, it's in my bag. If you've got a credit card, at the end of the month, you've got to pay that bill, or some of that bill. You owe money. It's supposed to go round the back, guys. It's locked? But those other students came in. Come in then, guys.
تهرب ولا في اليوم مشان؟
We have to go today to find out.
Yeah.
Get the data ready.
You have to be careful with organisations because you need to, for example, have a look at current assets and weigh them up against current liabilities. What happens if your current liabilities are larger than your current assets?
Before you fall in debt.
Bye-bye. That's very succinct, yeah. Bye-bye. Yes. Yeah, it does. Because a peculiar thing can happen. The people to whom you owe money can actually force a company into liquidation. They can wind it up. There's a creditor's liquidation process that they can go through. If they've been owed money, quite large sum, and for a particular amount of time, they can bring the company to its knees. So you need to make sure you've got a good current asset to current liability ratio. Right, to be solvent, our current assets must always be worth more than current liabilities. Example sheets, solutions will be supplied after you've had time to solve them. So, guys, there's no point saying to me we've done questions 1 to however many. I won't put the answer sheets up until you've had a good crack at them. Okay? Use the templates. Right, let's have a look at profit and loss account. Profit and loss, remember, it covers a defined period in time. It could be 3 months, 6 months, a year, it could even be 18 months. It includes all of the income, and income is typically generated from sales for products, but particularly in terms of software, sales for services. You retain the title to the software, and the software is leased. Includes all of the expenditure in that particular period. Expenditure will typically be what would be the largest expenditure that you're likely to see in a profit and loss account? Can anybody think?
Wages?
Purchase.
Yes, it is likely to be wages actually. Yeah, it is. And if you take income less everything that you've paid out, expenditure, woohoo! Hopefully, fingers crossed, you should have a profit. Else we've got a loss. So, we're going to use a straightforward example in which Unisoft Limited buys software, adapts it to customers' needs, and resells it at a higher price. Sounds like a business plan. In the first month of trading to September 2000XX, we have income from sales, £20,000. He's gone. So income from sales, £20,000. And that's where we show it, okay? We've got income from sales. We've got no expenditure whatsoever. So, woohoo! For that first month, we have got a profit of £20,000. To whom does that profit belong?
Shareholders.
Who said the company? Who said the... Okay. Yes, question. Say again? You were talking... Okay, thank you. And what was the answer? It would be... No. It would be all... No, hang on.
If they're shares, then...
It depends who the shareholder is. Yes, it's the shareholders. Just go for shareholders. Okay, good. And it balances. Can you see that? One side balances against the other. So the left side, just like the right side, the balance sheet, the P&L account will have a left-hand side and a right-hand side with totals that are equal, that balance. The right-hand side is about income received. The left-hand side is about deductions, costs or expenditure. So, If there are no expenses, then it's all profit. And it doesn't matter what the sales figure is, it's got to balance. So we would call it profit of £20,000. How many of you have read the study notes, financial? Okay. Then you know that the profit and loss is subdivided into two parts. The first part is the trading part. And it's everything that you need to do to trade. So, for example, if you are writing software and putting it onto, I don't know, some kind of media, or it needs to go through a factory or some, or you produce toothpaste and it goes through a factory procedure. You've got to have all the chemicals, which is stock, all of the stock, and that stock needs to be weighed against the sales that it can generate. Does that make sense? It's the trading activity. It's what the organisation is about. It's about selling toothpaste, about making toothpaste, it's about selling it. And those costs will vary. They're going to be variable costs. But there's another part to the profit and loss further down as well. We can call that office expenses or overheads. They are going to be fixed. It doesn't matter if you sell £1 billion worth of toothpaste or zero toothpaste. You will always have to pay the fixed costs. And those fixed costs are going to be the general office administration costs, such as office staff salary. So that will go down the bottom of the P&L. Let me ask you this. You're making your tubes of toothpaste and you need a staff of 40 technicians in the factory. Is it at the top or the bottom of the profit and loss account, their wages?
Bottom.
We have the bottom, okay? Anybody else vote for anything else?
Very bottom.
Interesting, okay. Let's just review what we've got. The top half is the trading account. It's everything that we need to do to make the product. So we make 1 million tubes of toothpaste. We sell 0, but we've still incurred those costs. If we make 0 tubes of toothpaste and we sell 0 tubes of toothpaste, hypothetically, you could argue, we're not going to pay the factory staff, they're not working. But you would still pay the administrative staff. I know it sounds cranky, but it's just the way it works. So therefore, if you had 10 staff working in a factory, and you have to pay the rent for that factory, and the light and heat for that factory, and that factory is used solely to make tubes of toothpaste, which are then sold, where do all those costs go? Do they go up at the top in the trading account, or down at the bottom in the administrative or office type?
Both somehow.
Top.
Yes.
Top.
Guys, are you comfortable? It's going to go in the top. It's going to be in the top.
If it's not working, close the factory.
Now, I'm not going to trick you in the exam. I will state quite clearly if it's factory wages or it's warehouse wages, etc., etc. And again, if you practice the questions, you'll know where to put it. And I will say office salaries or office rent. There is a difference. And the reason for that difference is, if you're interested, which you should be, in doing some analysis work on how much it's costing you, and this is very big in software, it really is, to be able to track supply all the way through, from the suppliers into the factory, out of the factory and into the warehouse. Because what a company needs to know, particularly in this day and age, and it costs millions of pounds in terms of software design, etc., they need to know at which point in that supply process they turn from potential loss-making into a profit-making. They also need to know how much by product, especially if you're making thousands of products, how much each product is actually costing to make. If you've got a factory that's going and it's making several hundred products in different routines, you need to know what the individual costs are and break it down. Guys, if you want to go outside and chat, that's fine. But do me a favour, please stop distracting me, okay? Thank you. So it is important to understand the difference between what goes up the top in the trading account and what goes down the bottom. Fixed costs are going to be fixed costs. You're going to have to pay those regardless. But the costs that go through, particularly a supply chain is big business. And in fact, I had forgotten, this type of system, you're talking about the massive systems, you're talking about the ERP type systems, enterprise resource planning systems. There is an Emerald Journal dedicated solely to latest research into technology, hardware, software, etc., and supply chain management, and that's worth a look. There's also a journal that's dedicated to ERP systems. They are so massive. And some of you might like to consider doing an industrial placement at the end of year 2, yeah? And SAP, guys, it's only up the road. It's at Bedfont Lakes. Bedfont is in between Hounslow and Staines. It's quite close to where I live. So, I mean, that would be a really rocking place to go and do an industrial placement. So, are we clear on the difference between everything that should go into the trading account? We will discuss it, but the difference between what's up top and what's down below? Yeah? Okay, well, we'll firm this up as we go through. Cost of stock. Here's an interesting one. Cost of stock. If you're in business year on year and you make 100 tubes of toothpaste, and only 100 tubes of toothpaste, because it's amazing toothpaste. It's very technical. It's guaranteed to get you a mortgage if you want a mortgage. It's, you know, you've got this smile that just, I don't know. But anyway, you get the point. You make 100 and 100 only. But as we all know, globally, what happens to the price of materials? They go up and they go down. So the stock cost is going to go up and down. And get this, we might make 100 tubes of toothpaste every year, but supposing, what's going to happen if we have a lean year? We haven't been able to sell them all, so we've only sold 50. We're going to have stock left over, aren't we? So our cost of stock is not going to be the same year on year for those 100 tubes of toothpaste. Does that make sense? Does it make sense? Yeah? Okay, so the cost of stock is the opening value of stock, brought forward from the previous accounting period, from the previous trading period, last year's accounts, plus anything that we've bought during this trading period, during this tax trading year. But that's not the end of it. We've got to deduct from those two figures anything we've got left sitting on the shelf. So we've got stuff that's come in from last year that's sitting on the shelf, sitting on our shelves. We've put more things this year added to the shelves. We've sold a lot of that, but at the end of that year, we've still got a lot left. We've still got a lot of stock left. And that stock that's left, which we haven't sold, has got nothing to do with this accounting period. We shove it forward. We take it out of the equation. And the way we do that is we deduct what we've got left and we put it in the balance sheet. Does anybody like to hazard a guess? Is it an asset or a liability? Asset or liability? Hands up who says it's a liability. Hands up who says it's an asset. Fence sitters. Is it a fixed asset or a current asset? Hands up who says it's fixed. Hands up who said, oh, fiddlesticks. You've got to be kidding. Okay. Current? Yeah, okay. Current asset, yes. It's carried forward as a current asset. So, it comes out of the trading account, which we generally call the profit and loss account, and it goes into the balance sheet. That's the other side of that equation. I'm not going to go into double entry. I know, it's locked, isn't it? Are you sure? Did you have a go? Thank you for your honesty.
Next time, don't say the door is locked if you're questioning them about that.
Is the door? Can somebody just have a? No, I'm not going to go there. I'm not going to go there.
Give it to go.
Okay, right. It's shown in the balance sheet under current assets as stock.
Yeah.
It's got nothing to do with that particular accounting period. We're going to carry it forward to the next year. So, we've got stock at the 1st of September of £5,000. That was carried forward from last year. That was already sitting on our shelves, £5,000 from last year. Yeah, very expensive toothpaste. We purchased another £8,000 of goods. Usually, in previous years, it's cost us £10,000, but hey, we've managed to get a discount. We're a very good customer with our supplier, and we've been given a discount. So it's only costing us this year £8,000. So the 8 and the 5 is 13. But hang on a minute. We've made 100 tubes of toothpaste, but we haven't sold them all. We haven't used all the stock either. So that stock has to come out.
Close this.
We've sold £20,000 of goods. The actual cost of the stock that we've used to make those sales of 20,000 is 6,000. Now take a minute just to look at that. I'll go through that again if you want. Say again? Yep. You've got stock that you didn't use last year that you're using this year to help make the sales, and the sales are going to be £20,000. You can sell 100 tubes of toothpaste or whatever, yeah? But in order to make those sales, you had to buy more stock. So last year's leftovers, yeah, and this year's buy-in makes £13,000. But at the end of that period, we haven't used up all the stock to make all those tubes of toothpaste. Or we've still got unsold tubes of toothpaste. So therefore, we have to take that out because it's nothing to do with this particular current period that we're looking at. It's to do with the future. We're carrying that forward. So therefore, we deduct it. Opening stock plus purchases less closing stock. Guys, don't worry about that. If you've had a look at the template that you get in the exam says that. And the other reason I've included on the template the little dots and the date is because if you're not sure, then state the date. Opening stock, add purchases. Less closing stock that we can't use, we've got to carry it forward. We haven't used it, carry it forward. Equals the cost of stock that has been used to sell, to make and sell £20,000 worth of tubes of toothpaste. Okay? If you're still not sure and you're uncomfortable about it, don't worry. Come and see me in the workshop. I'll be happy to talk it through with you, okay? So, hang on a sec. We've got, oh, this is interesting. We've got sales of £20,000. Woohoo! We've got cost of stock. We only have to spend £6,000. It should balance, shouldn't it? It doesn't. What's the missing figure?
Gross profit.
And is what?
Gross profit.
Is yes, and what's the figure?
14.
It's 14,000.
How many people think this joker at the front is right? How many think he's wrong? Fence it as the rest of you. No good you looking down. I can see you. I can see you. Yeah. 6,000. It's gross profit. And that gross profit is then carried down to the lower half. You okay with that? You okay? Anybody not sure? So other trading costs. In real life stock would not obviously be the only cost. You have to pay salaries to the production team, salaries to the warehouse people, all that type of thing to the factory people. They would be called trading. I think on the template, I can't remember, do I call them direct costs? Yeah, I call them direct costs, yeah. So the difference between the top is direct costs and the bottom will be indirect costs. Stephen?
What would a loss of stock be like? So you have a phone that's known to be sold in the market, just leave it.
Then you would write that off. You would write that off to the profit and loss account because you wouldn't be able to sell it. You'd write that down. And you'd show in the balance sheet the other side of the equation would be the lower of cost on that realisable value. So you would revalue the stock and it would be what you're likely to get because you can't have an inflated price. The other side of it is, of course, as I've just mentioned, factory or warehouse light, the electricity, rates, rent, anything like that. So the gross or the trading profit will be reduced by those amounts. So, the sales is always going to be the biggest figure that you've got. And the sales figure drops straight down to that top level. So if it's £20,000 on that side, it's going to be £20,000 on that side. And you can work your way up. Does that make sense? So you can find the missing balance, the missing figure. So if we've got cost of stock of £6,000 and we've got warehouse costs of £9,000 making 15, the difference between the 15 and the 20 is 5,000. That's our gross profit. Overhead costs. We've looked at sales income, direct costs or trading costs. In addition, we've got costs from non-trading activities. Non-trading. So even if we make and sell zero, we're still going to have to pay these overhead costs. So having calculated the gross profit, we now treat this as our income for the second part of the profit and loss account. And the further deductions will be overheads such as office rent, rates, light and heat, office salaries, the basic admin stuff. Because that's always going to remain fixed. So that's quite an easy figure if you want to do some analysis work, if you want to write software programs about those particular routines. Actually, it's not easy to write software about that, particularly on the wages side, because that's extremely complex software. That's probably the most complex software you can write for. So where else does the net profit go? Can anybody remember?
Balance sheet.
Yes,
At the
well
bottom.
done. To whom does the net profit belong?
Shareholder.
Shareholders. Guys, I think you guys on this side are a little bit reticent. I'm feeling this. And these guys are a little bit ahead of you, so, you know, a bit louder this side. Where is it shown?
At the bottom, where the shares and the last figures on the right. On the bottom.
It is.
I don't know what's it called. Yeah.
Get a bit louder. It goes on the other side, not fixed liabilities, it goes to shareholders' funds. So the shareholders' funds are going to consist, can anybody remember from last week? What's the shareholders' funds consist of? And have a look back at your notes.
Capital.
What do the shareholders' funds consist of? Remember Paul and Katia? Paul gave £5,001 and Katia gave 4,999, which is what? What would we call it?
Capital.
Capital, yes. So we've got shareholders' funds, we've got capital, and what else have we got? Net profit, yes. Hopefully not a loss. Good. Okay. What's an overhead? Well, this actually depends upon the business. A working definition is that they're costs which allow trading to take place, but they're not related directly to trading. So, for example, you might need office staff to arrange suppliers or supply information or anything like that, that's just a minor part of their usual day-to-day routine. They're not directly related to trading and not directly proportional to the volume of trading. So, the lower half, we've got the gross profit of 5,000. We've got overhead costs of office rent, rates, salaries, giving a subtotal of 2,400. And therefore, if we deduct that from £5,000, we've got what we call a net profit from total trading activities and total non-trading activities. That's what we have earned that particular year. And ostensibly, we could pay that out as a dividend if the directors declare it. So, this is just a brief introduction to depreciation. We bought a computer for £2,000, might only be worth £1,500 now, and the difference between the two is what we call depreciation, and it's an example of overhead costs. There are distinctions between depreciation. So, for example, depreciation of factory equipment, and factory equipment can be absolutely massive, would go at the top of the profit and loss or at the bottom?
Top.
Current.
If you've bought
Factory.
machinery for a factory and that machinery gets worn out every 4 years and has to be replaced, and it's crucial to production, you can't make your toothpaste without this particular machinery, it puts the cap on or something like that, then the depreciation would go at the top or the bottom of the profit and loss? It would go at the top. Yes, it would. If it's directly associated with trading activities, you're not going to be able to make the toothpaste without that machine. So, yes. If you want to do further analytical work, then you can take the cost of that out of the equation and do something quite different. If you've got, say the directors have got motor vehicles, £40,000 car each, yeah? And they get salaries, fixed salaries as well. Is that going to be at the top or the bottom? It's going to be at the bottom. So the depreciation on that type of vehicle is going to be at the bottom. It's got nothing to do with trading activities. It's got nothing to do with tubes of toothpaste. And even if they try and argue, and here's the thing, even if they try and argue that, well, actually, I do deliver personally tubes of toothpaste to individual customers, which adds to our kudos and it enhances our brand reputation. The tax people will not buy it. It's been tried, they won't buy it. You do not need a £40,000 car to do that, okay? There are certain rules. So, profit and loss account, we've got overhead costs, rent rates, salaries, depreciation. On a non-trading one, we'll go there. And that takes our expenses up to 2,900, so the difference between that and the gross profit will be £2,000. So what else? In practice, we put part 1 and 2 together to make the complete profit and loss account, exactly as you've seen already in the workshop. And those of you who've got the workshop with me after this lecture, you'll see it too, okay? But see your template. Use the template that you're given in the exam for the correct information. If anything changed, I'd make sure that you've got it in plenty of time to do practice before the exam, but it's unlikely to change. So the net profit so far is before any taxation. Taxation is outside this syllabus, but if there was tax, then you'd have the net profit, tax, and so on. And in actual fact, in reality, it would be the net profit, and you'd have to pay interest on loans, fixed interest on loans. We're not going to consider tax or VAT. Sometimes there are what we would call abnormal or exceptional items that go through a profit and loss account, and this is just purely for your interest. Sometimes a company makes, bad spelling, loses? I don't think so. I don't think so. Loose is what? A volley of toothpaste. Or loses money in a once-off manner. They might invest in something that is unsuccessful. Or if it sells an unwanted profit, property for a big profit. you're not in the business of buying and selling profit, it's a fixed asset, but you've made a very large profit, it would be unfair to show it in normal expenses in the profit and loss account because it would skew your profit for that year. If, as an investor, a potential investor, you were doing some analysis on the figures, it might induce you to part with your hard-earned cash that particular year. And so what they have to do is they have to show it as an exceptional item in the profit and loss. Another cost could be if it decides to reorganise. Perhaps some of you had that strategy for Cotton On and involves a large redundancy payment to ex-staff. So the exceptional items don't contribute to the net profit or loss, but they do give a fair comparison with previous years. In addition to the net profit, therefore, it's usual to get net profit after exceptional items. You have to be clear, you have to be open with people so that they can make a value opinion. So, what happens to the net profit? What happens to the net profit? Ooh, dead silence. Have I done you to death this morning? Shareholders, where?
Balance.
Where's it shown? You're right.
Right.
What? I know, yes I know. I love that, yeah. But here's the thing, the question's the other way around. What do you know? What do you remember?
Okay.
It goes to the shareholders. Where's it shown?
Balance sheet.
Right.
Down on the left. And what's it called in the balance sheet? Shareholder funds, yes. Okay. So, net profit, less taxation, profit after tax, dividends to shareholders. The retained profit is transferred to the balance sheet. You won't get dividends and you won't get taxation in the exam. Okay? And you won't get any exceptional items either. That's just purely if you're interested. Now, I've got some examples for you to do. Let's see how well you do. But guys, it's 10 past, I make it almost 10 past 10. Do you want a 10-minute break? You're gasping. Sorry. Let me out of here, please. You're begging. Let me go. 20 past? Yeah? 20 past? Can everybody hear me? 20 past 10. Not 25 past 10. Not 23 minutes past 10, please. Okay, guys, thanks for your attention. Well done.